Welcome to our next lesson in this introductory module. This will be the final Excel-based or calculation-based lesson here, and you're going to learn something very important, which is the most important formula in finance, which you can use to value any company. Now, once again, with this lesson, you can definitely read the written guide if you learn better like that. If you go to key rule number 4, how to value any company, the most important formula in finance, you'll see everything laid out there. In this case, I think it is helpful to look at the calculations as we go through them in video form, because you'll see in more detail how the numbers come together and how they change over time. It's harder to illustrate that in text with screenshots. So I do think the video here is helpful, although you could definitely still get by reading the written guide. We'll cover 4 main topics in this lesson. First, we'll talk about company valuation and go through the intuition behind determining how much you would pay for a company. Then we'll look at valuation with growth factored in and see what happens when companies grow and change over time. Then you'll learn the overall formula that you can use to value any company or asset and the intuition behind it. And then you'll learn why real life is more complicated and why, even though this formula is helpful for thinking through the basics of valuation, it doesn't really hold up in most scenarios, and you have to expand on this and make it more complex when you use it to value real life companies. Let's start with company valuation at a basic level. The question to think about here is, how much would you pay for a company that generates $100 of cash flow each year forever? The answer to this question depends on your targeted yield, or your opportunity cost, or your discount rate, whatever you want to call it. It represents how much you could earn elsewhere, and how much you'd be willing to pay for this $100 of cash flow every single year depends on what your other options look like. For example, if you could earn 10% elsewhere with assets that have similar risk profiles, for example, then you would be willing to pay $100 divided by 10% or $1,000, because 10% of $1,000 upfront each year is $100. On the other hand, if you could earn 20% elsewhere, then this $100 each year is less attractive to you because you have so many good options elsewhere. You'd be willing to pay $100 divided by 20% or $500 for this. 20% of $500 each year is $100. If you want to see this simple scenario in Excel, let's go into the Excel file here and start by entering the annual cash flow. I have initial cash flow of 100. Now, we have no growth in this first scenario, so we just take that 100 of cash flow, we multiply by 1 plus the cash flow growth rate, which is just 0%. And so our annual cash flow here is going to stay the same at $100 every single year. I have it going up through year 100, but it would actually go even beyond that. And so in this very simple scenario, it's just that initial cash flow divided by our discount rate, and that's how much we'd pay. Now, if you calculate this in Excel, just to compare and contrast, if we use the NPV function, 10% for the discount rate, and then we have all these annual cash flows, you can see it's almost the same. It's not quite the same because we don't go past year 100, but it is very, very similar. And the intuition is just that 100 divided by that 1,000 gives you that 10% yield that you were targeting from the start. Of course, in real life, companies also grow and change over time. No company generates exactly $100 of cash flow every year. Most companies will generate more cash flow over time as they grow, although some companies could also decline and generate less cash flow over time. Either way, though, there is some type of growth rate or contraction rate that you have to factor in when you're dealing with companies that actually change. Now, if there's growth, you can afford to pay more upfront and still earn that same yield you're targeting. So you could still get that same discount rate, that same opportunity cost or targeted yield if you pay more upfront, because growth will get you more for your money in the future. If you look at the annual yield in this scenario, it starts out low, but it keeps rising over time as cash flow increases. As that cash flow increases, it keeps increasing the discount rate in the long term. To see this in Excel, let's go down to scenario number 2, how much a company's worth when we have growth. Let's start by once again entering the annual cash flows here. We start out at this initial cash flow of 100. We assume here that our discount rate is the same, 10%, but we have 3% cash flow growth each year. So in year 2, we'll take that 100, we'll multiply by the 1 plus 3%, and we'll anchor the 3% part. And then we'll copy all these over and around. And so we have our cash flows from year 1 all the way through year 100 right there. Now, to calculate the present value of cash flows here, you can see the formula that I've entered down here. The initial free cash flow divided by discount rate minus the cash flow growth rate. So let's enter that and see what happens. We can just use the 100 here and divide by our discount rate minus our cash flow growth rate, 1,429. If we calculate this in Excel by using the NPV function, we use the discount rate up here, and then we have cash flows from year 1 through 100. We get to a number that's pretty close. It's not exactly the same because of the same issue that these years should go into infinity, but we only go up through year 100 here, but it is pretty close. And the reason this happens is because if we get 100 of cash flow in the first year, that's a yield of about 7%. So it's well below our discount rate of 10% right here. But then in the next year, this goes up to 7.2% because we have more cash flow. And then the next year beyond that, 7.4%. And 7.6%, and I think you get the idea by now. But this keeps going up every single year. And over the long term, if you plot this out until the very end, we get to very high yields here of over 100%, 130% by the end. Over the long term, if you look at the weighted average of all these, it will come out to be around the discount rate. And that's why growth is so important, because it lets you pay more upfront. And it ensures that your overall yield until the end of time will be similar because that extra growth makes up for the fact that you are paying more upfront. This leads us into our next topic, which is the most important formula in finance and the intuition behind it. Now, this formula is exactly the same as what I just showed you. Cash flow divided by discount rate minus cash flow growth rate. But there's one important addition, which is that the cash flow growth rate must be less than the discount rate. This formula doesn't make any sense if you let the cash flow growth rate go above the discount rate. If that happened, you would have to then modify the discount rate because you'd be saying that your opportunity cost is no longer 10%, but with this opportunity, you can get to 11%. So you'd have to modify the discount rate and the whole formulation wouldn't make any sense. So this is a really important constraint on this formula. If the discount rate is 10%, cash flow growth rate can't be 10%. It has to be 9% or 8% or 1% or something less than the discount rate. If the cash flow is higher, the company is worth more to you, which is pretty intuitive, I think, because cash flow is in the numerator here. And if cash flow is lower, the company is worth less to you. If the discount rate is higher, the company is also worth less. You know that because with a higher discount rate, the denominator is a higher number. Therefore, the whole fraction is a lower number. And if the discount rate is lower, the company is worth more to you because when the discount rate is lower, the whole denominator is a smaller number, and therefore this fraction comes out to a bigger number. With a higher discount rate, you have better options elsewhere. With a lower discount rate, you have worse options elsewhere. If the cash flow growth rate is higher, the company is worth more to you for the reasons you just saw. You can pay more if there's more growth because you can pay extra and still get to that same yield because of the fact that cash flows are growing and your annual yield each year keeps going up. If the cash flow growth rate is lower, then the company is worth less to you for the same reason. The significance of this formula is that everything else in this course relates to it in some way. So the accounting lessons, for example, deal with cash flow and determining what a company's cash flow really is based on its financial statements and how an accountant would view the company. The valuation and DCF lessons are an expansion of this formula. We still use this extensively, but we have to expand on it and we have to look at what happens when some of the assumptions in this formula change or when it doesn't quite hold up in all cases in all years. Even the lessons on M&A deals, mergers and acquisitions, LBOs, leverage buyouts relate to this in some way, because one of the ways that you can judge how good an acquisition or a buyout of a company will perform is by using this formula and seeing what the cash flows look like over time and what the potential returns look like compared to the discount rate. So everything in the course is related to this formula in some way, either going into part of it in more detail or expanding the formula or using this formula in some different approach. Let's now look at why real life is more complicated and why, even though it's useful to think about this formula conceptually, it gets more complex and you can't quite rely on it in all real life scenarios. The first problem is that companies' growth rates change over time. No company out there is going to grow at 3% or 5% or 2% each year, every single year until the end of time. Companies tend to grow quickly in the beginning when they're first starting out, but then their growth rates tend to slow down over time as they mature. So cash flow might grow at 10% this year, and then 7% next year, and then 5% the year after that. Another problem is that the discount rate might also change over time as a company's risk and potential returns change. So if you're looking at a new technology startup, for example, the discount rate will be really high, 30%, 50%, maybe even higher, because there's so much risk. You don't even know if the company will generate revenue yet or find customers or anything like that. But then once it starts generating revenue, if it does, and it finds customers and it starts building up its business, the discount rate goes down because the risk is significantly lower and the potential returns get significantly lower as that happens. So you have to factor in both of these, and that's why you can't quite rely on just this formula. You often project the first 5 to 10 years of a large public company using custom numbers that you create. You come up with your own estimates for their cash flow and growth rates and discount rates, and then you assume the company stabilizes after that. Now, in this stable period, also known as the terminal period, the formula I just showed you does apply, but before that, you can't quite use it, and you have to come up with the company's present value of cash flows manually yourself. Now, this is just an introduction to the topic. You should really look at the valuation and DCF coverage in modules 7 through 9 of this course if you want all the details. But just to give you a flavor of what you might have to do, let's go into Excel once again and go over to the Real Life tab. I explained the setup over here. We're assuming that the company's initial cash flow is 100. The discount rate in the first 10 years is 10%. After those first 10 years, the discount rate falls to 9%. The company's cash flows only grow at 2%. Now, in the first 10 years, the company changes over time. So the cash flow growth rate starts off rather high at 10%, and then it drops to around 2 to 3% by the end. Now, in real life, you would probably not go beyond year 10. You'd probably just stop here, but I want to show you some of the math and how it lines up to what Excel calculates. So once again, I've gone out to year 100. If we calculate the annual cash flows here, we'll take the old number and we'll multiply it by 1 plus the cash flow growth rate. So we have this through year 10 and then ultimately through year 100 by the end. Now, for the present value of cash flows in years 1 through 10, the period where the company is actually changing, we can use the NPV function. The discount rate is the same each year, so we can just use this built-in Excel function. And we can take year 1 through year 10, the cash flow in each of those years. So we have that. Now, for the next period, we can take the very first cash flow in year 11, which is the first year of the stable period or terminal period. And then we can divide by the discount rate minus the cash flow growth rate in that period. So we get to that. Now we have to discount this value to present value today because this number is the present value as of the end of year 10 or the beginning of year 11. But we want to figure out what the company's worth today all the way back in year 0, right before year 1 even begins. So we discount this based on 1 plus the discount rate of 10%. We're using 10% because that's the rate that applies in the first 10 years. We raise it to the power of 10 and we get our discounted value like that. And the implied company value is just what its cash flows are worth in years 1 through 10, and then what its cash flows are worth beyond the end of year 10. And that's a flavor of how we can get to a company's implied value in a very simple way. We would then compare this to its current value and see if the company is worth investing in. So if its asking price is above this, then it might be overvalued. If its asking price is below this, then it might be undervalued and it might be worth investing in. Or if it's about the same as this, then maybe it's appropriately valued and we don't do anything right now. Again, we get into all of this in a lot more detail further on in the course, modules 7 through 9, but I want to give you a flavor now and explain how and why this formula is important. Let's do a recap and summary. With company valuation, the amount that you pay for a series of cash flows depends on your discount rate or opportunity cost or targeted yield. If it stays the same each year, then a company's value is just the cash flow each year divided by that discount rate. So 100 divided by 10% gives you 1,000. Now, if there's growth involved, then the formula becomes cash flow divided by discount rate minus cash flow growth rate, because if a company is growing more quickly, you can afford to pay more upfront and still get to that same targeted yield. The formula is exactly what I just stated, cash flow divided by discount rate minus growth rate, where the growth rate must be less than the discount rate. The intuition is that a company is worth more if its cash flow is higher. A company is also worth more if its discount rate is lower, because it means you have worse options elsewhere. And finally, a company is also worth more if its cash flow growth rate is higher, because you can afford to pay more for that extra growth. Real life gets more complicated because companies change over time, so you can't use just that formula. You tend to project companies for 5, 10, 15, or even 20 years. You calculate the present value of cash flow in those years, and then beyond that, you can apply this formula, and then you can discount those far in the future cash flows to their present value today, add up everything, and determine the company's implied value. That's it for this lesson. Coming up next, we will look at what makes financial modeling difficult and why we need an entire course to explain all the nuances, even though we've been over the fundamentals and most important concepts in this introductory module.